Okay, next we're going to move on to some of the risk analysis tools that we've built. And again, these are kind of designed based on some of the tools that banks certainly use and certainly larger corporates would use, and making them more accessible for mid-sized companies. So the first one is VAR analysis, value at risk, very common concept in large corporates and in the financial world. What it does is takes your exposure, goes back, looks at historic moves of those exposures over a certain period of time, and obviously users can tailor this, and then picks what your kind of worst case negative move in your exposures might be over a certain time horizon to a given confidence interval. So in this case, we're going to look back at 5 years of data, look at a 1 year horizon going forward, and I picked that 95th worst case outcome for us. So again, we go out to the market, pulling in spot prices, historic data, calculating the historic volatility, and either, depending on the model we use, you can generate a large number of hypothetical future scenarios and pick the 95th worst one, or you look at just rank the historical market moves and pick the 95th worst one and apply it to your current portfolio and price. And what does that tell you? Your unhedged forecasted cash flows, total notional of 226 million. Potential worst case market move, they fall in value by or become more expensive by 20 million euro. You bring into account your hedging trades, and that risk reduces by about 7 million euro. And then if you bring in your potential trades, it reduces by another 2 million. I suppose the important thing to note here, if you look at the forecasted cash flows, is 200 million. When you take the hedge notional into account, that reduces to 100 million, so more than a 50% reduction. But when you look at the actual risk reduction based on the VAR analysis, the risk number here only reduces from 20 million to about 13 million, so only reduces by about a third, which is exactly the type of insights you want to show your treasury managers that, look, you are doing a lot of hedging, you've hedged over 60% of your exposure, but actually your potential risk is only reduced by about 30%. And then again, graphically from a reporting point of view, you could show your total exposure, the value you have, the fact you've exposures to multiple currencies, there's some diversification there, gives you your 20.5 million VAR number. And then you see here the benefit of your existing hedges. And if you are planning on the potential trades, you can include them in here, and still leaves you with quite a large VAR number. So probably maybe more hedging to be done. And again, you can also look at how that profile moves over time as risk increases as you move further away from the current date, but also then as you go through time, your trades and your exposure start to settle, so your overall exposure reduces. So yeah, VAR is a great tool for giving a general view of what your kind of worst case risk is in the normal course of business. Obviously, everyone who's been involved in markets knows that every so often you get these once in a lifetime events where you get a huge shock to the market, and obviously anyone looking at their exposure with a real risk lens wants to know how vulnerable they really are if something like that happens. So what we've done here, we have selected a couple of scenarios that people will be familiar with, your global financial crisis, European debt crisis, Brexit, etc. Um, and we can apply those shocks to the customer's portfolio or user's portfolio, or if they want to set their own shocks and negative valuations, they can do that on a exposure by exposure basis. So yeah, let's go with Brexit. Everyone remembers Brexit. And then, so what happened during Brexit? Sterling dollar dropped by 10%, euro sterling weakened by 8% against the euro. UK interest rates dropped by 25 basis points, euro dollar was fairly stable. So you can include that. If your exposures aren't covered in, or if you have other exposures that weren't affected by Brexit, you can either look at how they moved during that historical period, or if you want a real worst case scenario, you can apply the 99th percentile worst case VAR. So run the scenario analysis again, goes back, looks at the historic period, applies that to our trade set, and again gives you another similar set of numbers to the VAR analysis, but in this case, obviously much worse. So you can see the 20 million, the 95th worst percentile move was, I think it was 20 million. In this case, a rerun of Brexit for someone who has quite a lot of sterling exposure. You see the 38 million negative valuation, and again, the risk reduction is only about, well, less than a third now, only about a quarter. So again, have you fully hedged the right exposures? And look, there is a breakdown by exposure, so you can see where the real risks are there. So that's the scenario analysis and the VAR analysis, again designed to give a user proper in-depth understanding of what their real risks are and where they lie, and whether they are hedging them appropriately or not. That's it for that. I'm going to look at counterparty benchmarking next.